What if the next financial crisis doesn't start with greedy bankers or bad mortgages, but with an algorithm? Imagine this. Markets are falling. Trading bots panic. AI systems start selling everything at once. Liquidity disappears in seconds. And before humans even realize what's happening, trillions of dollars in value are wiped out. Today, we're talking about how AI could actually make the next 2008 financial crisis even worse. Faster crashes, bigger contagion, and less human control over what's happening. Stay with me until the end because I'll also share what regular investors like you and me can actually do to avoid getting completely wrecked if something like this happens. Welcome back to AI News. My name is AI News, and here we talk about money, investing, and how technology is changing finance. If you like understanding what's really going on behind the scenes in the financial system, make sure to follow, and let's get into it. To understand the danger of AI in finance, we need to look back for a second. In 2008, the global financial crisis was triggered by toxic mortgage products, insane leverage, and a lot of people trusting models they didn't really understand. Those models said things like, "Don't worry, this is safe," right up until the moment everything collapsed. Now fast forward to today. We still have leverage. We still have complex financial products. We still have people who trust models more than common sense. But now we're adding something new on top. Artificial intelligence. And AI is being plugged directly into trading, risk models, credit decisions, market making, and even the design of new financial products. That is incredibly powerful, but it's also incredibly dangerous. Because the same features that make AI so good at making fast decisions can make everything blow up much faster when things go wrong. So let's break this down. First, how AI is already used in finance. Then how it could actually make the next crisis even worse than 2008. Then how regulators might react. And finally, what you and I can do about it. Let's start with where we are right now. AI in finance is not science fiction. It's already here. Banks, hedge funds, and trading firms are using AI for things like algorithmic trading. AI models make buy and sell decisions in milliseconds based on patterns in price, volume, and news. High-frequency trading. Not all HFT uses AI, but more and more firms are using machine learning to optimize strategies that operate thousands of times per second. Risk management. AI is forecasting things like default risk, volatility, correlations between assets, and so-called tail events. Fraud detection and compliance. AI flags suspicious transactions, unusual activity, and money laundering patterns. Credit scoring. AI helps decide who gets loans at what rate and who gets rejected. Customer service and robo-advisors. Chatbots and automated advisors give people investment, suggestions, and portfolio allocations based on their profile. On paper, all of this sounds amazing. Smarter, faster, more objective decisions. Fewer humans making emotional mistakes. Lower operating costs for financial institutions. But here's the problem. The same things that make AI powerful also make it very dangerous when the system is under stress. So let's talk about the first big issue, algorithmic herd behavior. In 2008, humans panicked together. Banks stopped trusting each other. People sold everything. Credit froze. Now imagine that same herd behavior, but turbocharged by AI. Most AI trading models are trained on very similar data: price movements, macroeconomic indicators, order book information, news sentiment, social media signals. When those signals turn negative, a lot of these models may learn the same reaction. Sell risk assets, move into safe assets. Now, if just a few hedge funds do this, markets wobble. If thousands of AI systems do it automatically and simultaneously, you get massive selling pressure, sudden crashes, and liquidity disappearing almost instantly. Unlike humans, AI doesn't hesitate. It doesn't say, "Maybe I'm overreacting." It doesn't call a meeting. It doesn't go for a coffee and think about it. It just executes its rules. So instead of a slow panic over weeks or months, you could see a violent cascade in minutes or hours before regulators or central banks can even figure out what is going on. Now let's talk about the second problem, feedback loops and flash crashes. We've already had a taste of this with flash crashes, days where markets suddenly drop hard for no obvious reason and then recover quickly. Most of the time, these events are linked to the way trading algorithms interact with each other in unexpected ways. Now add advanced AI models into that mix. Here's how a nasty feedback loop could look. One AI system detects a small price drop and sells to protect its portfolio. Other AI systems see this increased selling and interpret it as a signal of rising risk. They also start selling. Volatility spikes. Another group of AI models is programmed to reduce exposure when volatility rises. So they start selling too. Market makers widen spreads or pull back because the market feels toxic. Liquidity dries up, and prices gap down because there are almost no buyers left. All of this can happen faster than humans can diagnose the problem. By the time someone at a central bank or a big institution realizes what's happening, the damage might already be huge. And remember, these models are often black boxes. Even the people who built them don't always fully understand why they behave a certain way under extreme conditions. You can't just ask the market, "Hey, why did you crash 20% in 5 minutes?" There's no simple answer. Now let's move to problem number 3, systemic risk, when everyone uses similar models. In 2008, part of the problem was that everyone trusted similar risk models. Those models said things like, housing prices never fall everywhere at once, and these products are diversified, so they're safe. Those assumptions were wrong, but because everyone used similar models, they all made similar bad decisions. Now imagine the same thing, but with AI. Banks use AI to decide which loans are safe. Asset managers use AI to build optimal portfolios. Trading desks use AI to hedge risks in complex ways. Insurance companies use AI to price risk. Even small investors might rely on AI-powered robo-advisors. If those models share similar assumptions or are trained on similar historical data, they can all be wrong in the same direction. For example, an AI model might say, these assets are not correlated, so they are safe together. So funds and banks pile into the same trades in the same safe assets. But in a real crisis, correlations often go to 1. Suddenly, everything starts moving down together. The risk was there all along. It was just hidden. The danger with AI is that it can give people a false sense of precision. The model might say, there's only a 0.01% chance this portfolio loses 30% in a day, so we're fine. That sounds scientific. It sounds professional. It sounds safe. Until that 0.01% scenario actually happens. And then everyone discovers the entire system was much more fragile than it looked. Now, problem number 4, speed. This is one of the biggest differences between 2008 and a potential AI-driven crisis. In 2008, housing prices crashed over months. Banks failed over weeks. Governments had some time, even if not much, to react. News traveled slower. Information was less automated. And many decisions still went through human hands. In a future crisis with AI in the loop, trading happens in microseconds. Decisions are automated. Portfolios are rebalanced globally in real time. News, social media, and sentiment are processed instantly. That means a problem in one market can spread to others almost instantly. Stocks, bonds, crypto, foreign exchange, derivatives, all connected. An AI system in the US might react to a signal from Asia. A system in Europe reacts to the US. Everything feeds into everything else. Human decision makers, regulators, risk managers, central banks are always behind. By the time humans step in with circuit breakers, emergency meetings, or bailouts, the AI systems may have already dumped assets, triggered a chain of defaults, and pushed prices into a freefall. It's like trying to stop a car crash when the vehicles are moving at the speed of light. And then there's problem number 5, humans being taken out of the loop. To stay competitive, financial firms push for more automation and less friction. Instead of analyst, risk manager, trader, execution, you increasingly get data, AI model, trade. No questions, no discussion, no human. Saying, wait, does this actually make sense? In the short term, this looks efficient, cheaper, faster, more data-driven. Multiply that across thousands of firms around the world, all trying to be the fastest and the most optimized. When things go wrong, people will ask, who approved this? And the real answer may be, no one did. The system just did what it was trained to do. That might be acceptable on a small scale. A fund loses money, a strategy fails, investors learn a lesson. But when this kind of automation is plugged into the entire global financial system, you're dealing with a level of complexity that no individual can truly understand. That's how you get a crisis that's not just big, but unmanageable. Now, you might be thinking, okay, but what about regulators? Won't they just control this? Let's talk about that. Regulators are trying to catch up. Some are talking about AI oversight, algorithm audits, transparency rules, and limits on fully automated trading. But there are a few challenges. First, regulators are always reacting to the last crisis, not the next one. Rules are usually written after something breaks. Second, many regulators simply don't have the same level of technical expertise or computing power as the biggest banks and hedge funds. They're trying to oversee systems that are more complex than anything they've ever dealt with. Third, even if regulators demand explanations, many AI models can't provide simple, clear answers. They're black boxes. They work until they don't. So yes, regulation can help slow things down, add guardrails, and require things like circuit breakers and stress tests. But it's unlikely that regulation alone will completely remove the risk of an AI-driven meltdown. That's the big picture. So after all this, what can regular people actually do? Again, I'm not giving you financial advice here, but I will share a few principles that might help if you're worried about an AI-driven financial shock. First, don't blindly trust anything just because it says AI-powered. Marketing loves buzzwords. A product or app using AI does not automatically mean it's safer or smarter. Sometimes it just means more complicated. Second, be very careful with leverage. In every crisis, especially fast ones, the people who are over-leveraged are usually the first to get wiped out. If you're borrowing heavily to invest, you're putting yourself at the front of the line when forced liquidations start. Third, diversify across asset types and institutions. Diversification is not a guarantee of safety, but being all in on one asset, one broker, or one strategy is extra risky when things move fast. Fourth, think in terms of time horizon. If you're a long-term investor, sharp crashes are painful, but they are not always the end of the world. The real danger is being forced to sell at the worst possible moment because you have no cushion. Fifth, keep some kind of cash or liquidity buffer. In chaotic markets, cash equals flexibility. It lets you survive downturns and maybe even buy when others are forced to sell at distressed prices. Sixth, build skills, not just positions. The more you understand how markets and technology interact, the more options you have in your career and in your investing. There's opportunity in learning how these systems work, not just fearing them. And finally, don't outsource all your thinking to algorithms. Use tools, use technology, use AI as an assistant. But remember, at the end of the day, it's your money, your risk, and your life. AI itself is not good or bad, it's a tool. It can help reduce risk if it's used wisely, or it can amplify risk if it's blindly trusted and left to run the system on its own. The scary part is, we probably won't know which one it is until after something breaks. So let me know, do you think AI will prevent the next big crisis by catching problems early, or cause it by making the system too fast and too complex? If you found this breakdown useful, don't forget to follow AI News for more deep dives on money, technology, and the future of finance. Thanks for listening, and I'll see you in the next one.